Hello, and welcome to the Total Wealth Academy podcast, video podcast. This is our second episode, and as I promised you, I'll be bringing you some of the top sponsors and syndicators from around the nation to answer questions and just give you an overview of what's really going on at Total Wealth Academy and really in real estate in general. Darwin is a man who started in real estate the old-fashioned way, child labor. While other kids were sleeping in, he was fixing AC units, cleaning pools, doing make-readies, and getting life lessons from his legendary father, Big Dar. From a beat-up 14-unit deal to over $1 billion in real estate, he survived crashes, lender retrades, FBI investigations, riser sprinklers, nightmare rehabs, rogue contractors, and more tenants than any man should legally have to endure. He's the founder of Darwin German Real Estate Investments, author of Full Disclosure, and the only guy who can walk into a distressed property and see opportunity instead of a hazmat scene. So please welcome Darwin German. Darwin, thanks a lot for coming on the show.
Thank you. Maybe not the only one, but yes, that was a good
One
intro.
of.
Thank you. That was fun. That was fun. Thank you.
Yeah, one of the only. Well, let's start off with, I was curious, you've done $1 billion worth of deals. You started off with a 14 unit. But my question, let's go back before that. Were you in corporate America? Did you have a job at one point?
No, I've never been in corporate America at all. I actually grew up, my dad was an auto mechanic, great grandfather was an auto mechanic, grandfather. They were all auto mechanics, but they all owned their own business and they all said invest in real estate. So I grew up, like you said on the intro, with child labor. My dad had me up at 6 a.m. working on properties and doing that. Always said work smarter or work harder. And so he would always put me to work, and that was his ethos. He was up every morning and had me up there doing the same thing, doing make readies, re-roofed a building when I was 12. So that child labor kicks in there.
Yeah, it's amazing. The harder the childhood, the more successful the individual in the end. So that's really cool that he did that for you because he was
Absolutely.
preparing you for a very successful career. Well, let's talk about the first deal that you did, the 14 unit. Tell me how you got involved in that. What gave you the courage to do it? Or was it just such a sweet deal you couldn't pass it? How'd that work?
Well, all of the above, actually. I moved to Texas in 1991, and I started a business called Options Real Estate. And my business partner was a guy named Monty Anderson. And Options Real Estate is still in business now, and Monty Anderson, very successful. But he had a friend who had a 14-unit property for sale in Oak Cliff. Okay, Oak Cliff, for those of you who don't know, is one of the more distressed, harder places to invest. And it was 14 units. Get this, Steve, $80,000, nothing down.
Wow.
Okay, does that raise red flags for you? But you remember this is 1991, but this guy was brilliant. He had the same property, he paid cash for it, and then he would sell it with owner financing, and he would get 20 to 30% down each time. And they would eventually default because it was such a rough area. He'd foreclose. He wouldn't even go to the property then. He just put it in the paper and say, here, for sale, owner financing, and some schmuck like me would come in there and buy it. Well, the biggest reason why I had some courage on doing that is I had investment experience, through my father. And I also had two partners on that. I had a construction partner and I had a management partner. So I was putting in most of the money to go ahead and do it, but it was an absolute hellhole. You remember the scene on Indiana Jones where the floor is moving?
Yeah.
I went into an apartment and the carpet was moving because of so many cockroaches underneath the carpet.
Oh my God.
I was talking with one lady who was a resident there, and she was standing there and a cockroach crawled out of her hair and she didn't even notice it. And the reason for that is everybody there was a drug dealer or drug addict. There was
Wow.
more traffic there than 7-Eleven. Trails coming in. We found 130 syringes. It was just a very distressed, very bad property.
Yeah, I've got to tell you that my very first 10 unit was the same strategy. It was an owner finance deal from an attorney where he would take the down payment and then foreclose on them, sell it again, foreclose on them. But when I picked it up, I was so committed to making it work, just like you were, that he was frustrated. He actually visited my house one time going, I really didn't think you were going to make it.
I was counting on you failing.
Yeah, he
That's
was
how I make my
counting on
money
it.
is I keep on selling it 100 times.
So tell me a little bit about did you evict everyone? What'd you end up doing?
Well, our strategy on that was that if you go through and try to victim forcefully, go into court, everything else, that wasn't gonna do very well. So my partner and I went out there on Friday and Saturdays, and even into the evening, and anybody that showed up, we'd say, "Hey, you here to score? No, you're not. Leave. We're gonna call the police." So we killed their traffic, is what we did, so that they would leave on their own. Now, that
Interesting.
is not a strategy I would recommend to anybody. That was probably pretty dumb and pretty stupid and dangerous on our side. But we killed the traffic, got most of the people to move out. And oh, it's funny. Our first manager there was such a wackadoodle, for lack of a better phrase. She allowed no smoking outdoors because she didn't want to harm the environment. But she was a lady there that lived there and took care of the place, and just craziness. It's craziness.
Yeah, so she was kind of the busybody. She knew everybody and could manage it.
Yep, and just really crazy. A couple of less other lessons on that is I had two partners. One was a construction partner, and this was a guy that I had first moved to Texas. This is my first experience with a Texas contractor. And he would wake up in the morning, he'd be out of the job at 8 o'clock in the morning, cooler full of beer. He'd be drinking a beer and drink it and throw it. He could throw it out the back window, out of his window into the back of his truck. But he would drink all day while working. And he kept getting ACs stolen and everything like that. And he finally said, "No, I can't do this anymore. I give up." And he was working for Sweat Equity. Well, his bid to do everything, when we went to hire another contractor, it was 3 times the cost.
Oh, wow.
So one of the lessons on that is get numerous bids, and even if it's a partner coming in to offer something, you need to pay him the right amount. You need to pay him a fair amount, and if he wants to reinvest, great. But you definitely need those other bids so you don't get screwed like I did.
Yeah, that's a very good point. Well, let's move up to your first bigger deal or your first syndicated deal. Tell us a little bit about your first syndicated deal and how that worked out.
Well, I learned about syndication through another investment group, and I said, I've never thought about that. I've got a lot of experience, and people will possibly invest with me on that." So I said, let me see." So I went out and and put a property under contract. At this time, I was pretty low on funds, so it was my last $100,000 non-refundable earnest money, and I put that up, and I went, "What the hell am I doing?" And I was terrified. And all I said is, "I only need $1 million. I need 10 people with $100,000. I'm like, 10 sales. That's all I need is 10 sales. And I get my property purchased and going to make a fortune." So it was a real difficult thing that I turned around finally and said, "I can do this. I only need 10 people with 100 grand," and bought that. And that was a property called Saginaw Crossing. And that was in 2007 that I bought that, or 2008. But I still own it today. We've actually bought it from ourselves 3 times because it's such a great location and a great little property, and there was always more meat on the bone.
Wow. And when you bought it in 2008, had the recession hit yet, or was that a little bit
It,
before?
it had already hit. Funny thing is, this was a syndication with a group out of Oregon. And the syndicator saw that the value went down, so the syndicator bailed on them and left them high and dry. And so they were feeding this property. They hired a property management company to go in there, and they never spent the $500 to fly down and look at the property. And this property management company just ran them over the coals, just
Wow.
absolutely mismanaged, horrible, self-dealing, and just were running it into the ground more and more and more. So the sellers were very motivated. Excuse me. Sellers were very motivated. And so we actually, because you couldn't get finance in there in that 2008 range, we actually did a wrap. So if you're familiar with that,
Yeah.
a creative way of financing it. And we did a wrap and bought that and just turned it around and did a great deal.
Well, share with us a little bit about the how did the passive investors get affected? What do you remember the rates of return that they got?
Oh, geez. I don't remember
I
off
know
the
that's
top of my
way
head.
back. We can talk about another deal if you want.
Well, it's okay. I won't know any of the numbers right off the top of my head because we've done so many full cycle deals. But our overall average over the last 35 years is over 30%. We don't
Wow.
advertise that. We actually say if anybody asks that it's 18% because 30% is just ridiculously high. But we were in
Yeah.
such a great market that returns were abnormally large.
Yeah. A lot of the stuff that was bought in 2008, 9, 10, 11, 12 ended up with that 30 plus percent rate of return. And that's just a different market now. So
Yep.
18% IRR is what you're projecting on a lot of your deals.
I look at it's got to be between a 16 and 18%. I use average annual rate of return just for simplicity's sake. A lot of people don't understand internal rate of return.
Sure.
But for average annual rate of return, I look for a partner level 16 to 18%. And that's usually with conservative underwriting so that we can go ahead and beat that. And obviously we beat that on just about every deal getting an average of over 30% because the market did go crazy. So we were planning on that 16 to 18%, but the market just spiked us quite a bit, just like everybody.
Wow. That's amazing. 30% rate of return, which is, of course, three times the stock market average. And it's
Oh, but past
less volatile,
performance is no
safer.
guarantee of future results. So,
Yeah,
definitely always in
understood.
there. Yeah.
Understood. Well, tell me a little bit about your plans for the future. What are you thinking about doing?
Oh, I'm still going to keep on syndicating. We've actually got three of our boys working for us in the company now. And so we've got one, Garrett, who's doing investor relations. He's been working for about 5 or 6 years already in dealing with investors and talking to them. And my son Zach is just came on board. He's more of an analyst personality, so he's been doing great on analysis, et cetera. And Garrison, who is doing apartment locating, he was an apartment locator for another company, but now we brought that in house. So we're doing centralized leasing. We still have on-site leasing, but centralized leasing. So we're really looking at incorporating more AI, more automation, and more centralization because we have to do everything we can to get our expenses down and have better control. And by doing that, that allows the on-site staff to focus on the customer service and the resident relations rather than dealing with a lot of the business functions. And that's just to provide better customer service, higher renewal rates, which keeps our expenses lower and keeps our income up. So it's just
Yeah.
a good plan, I think.
Yeah, that tenant retention is everything for sure. Okay,
Absolutely.
let's talk a little bit about the market, the way it is today, and where you may see it going in the next year or two. We've seen interest rates drop a little bit. Not sure if they're going to drop any more. What do you see happening in the marketplace right now?
Well, I'm going to have to back up a little bit and tell a little bit of a story. We actually bought our first property. My dad bought a property in 1989 in Duncanville, Texas, and we were from California. And then we had a client take over, or a family friend, we call him a client then, um, family friend that took over an entity that had a lot of money. And they said, where's the best place to invest? And my dad told them, Dallas Fort Worth is the best place. And they basically said, well, what do you know? 5 years ago, you were an auto mechanic. So they went to their big time advisors at Goldman Sachs. And Goldman Sachs says, best place to invest is DFW. They said, hey, he knew what he was talking about. He said, here's $20 million. Go invest it. Here's 20 million more and 20 million more. So we invested $120 million in between 1990 and 1994,
Wow.
and that was RTC days. So that was in the wake of the crash in 87, 88, and there was no money available. RTC was taking over all these deals, And get this, Steve, we were buying 5-year-old properties for $20,000 a door,
Wow.
but we were paying cash and closing. Our longest escrow was 14 days. And that was only because of title work. So we came in hard and fast with a lot of money on the back end of that recession, of that market correction. And so we bought a lot then. Then, of course, 2001 with the tech bubble, and of course, 2008 with that whole fiasco. So I've been through a couple of downturns, and now we're at another major downturn right now. And if you look at that market clock with the high being 12 o'clock and the low being at 6, I think we're at about 6 o'clock because
Wow.
I came in at the tail end of one recession or downturn and bought after two other downturns. And I just want to scream from the mountaintop. Now is the time to invest. Get out there and invest. The properties are on sale. We're buying things at 30% below their highs. So, buy it at a dip and go on, buy on the dip and keep on going up. But the problem is people are too afraid right now. And because they've seen everybody get hurt the last few years, because 2022, right before they raised interest rates, that was the highest we've seen, and we sold half of our portfolio in 2021, seeing how high everything was. But now is the time to redeploy capital and buy these incredible opportunities that are out there.
Yeah, I saw a deal this morning, $35,000 a door. And it's in a decent area. It's probably worth 50 as it sits. They're going to put about 500,000 into it and try to get it up to around 60 or 70 a door. That's just a phenomenal deal. And I'm
That's
seeing more
great.
and more of that. I'm sure you are too. Um,
Yep.
with the market down, how long do you think this is going to last? Are they going to have to lower the interest rate some more to get it back up? What are you thinking?
No, I think the biggest problem right now, and like I said, I've seen this after the last couple of corrections, is that it was so hot in 2021 that everybody was doing everything they could to get properties built. So they entitled the land, they got their construction loan, they started building, and they started that process. And you can't stop that process once you get started. And in 2022, with interest rates just skyrocketing, those properties had to be completed. And so now that they're completed, which is the highest amount of development we've had in ever. And so many units came out of the ground that there's huge lease up incentives because of all the new construction, and the absorption is not there. So they're offering incredible deals. I've seen as much as 3 months free rent
Wow.
on brand new Class A deals because they have to lease them up. Well, what that's doing is, it's funny, the rates on the effective rents on brand new properties are lower than existing Class A properties. So what's happening is people that can are moving out of the A's into the A pluses. They're moving out of the B's into the A's. They're moving out of the C's into the B's, and they're moving out of the D's into the C's. So
Wow.
you've got the D level residents in the C quality properties, and because of that, that's just hurting the overall value of every one of those up and down the board. Now, the completions are stopping. We're actually on the downward slide of the new completions. And because of that, lease ups are going to start going slower. So I think in 2027, 2028 are going to be great times to sell because that absorption is going to be kicking in. All of those rates will go back up. And again, the A's will go back down to B's, the B's back down to C's, the C's back down to D's. And because of that, those rental rates will go back up and increase the value of every property. So two things combined, well, a few things combined. The the completions finishing, tapering off, the lease up concessions tapering off, and interest rates hopefully being a little bit lower, and that stability coming back in the market is going to just make the market explode. I think 2027, 2028 is really going to be great years. But if you don't buy now,
That's exactly
then
right.
all the big players, I mean, there's trillions of dollars sitting on the sideline waiting for these opportunities. So So like I said, now's the time to buy. I think we're in that 5:30, 6 o'clock on that market clock that I was talking about a minute
Yeah,
ago. Not maybe not right at the bottom, but real dang close. So I think it's time to buy.
I agree with you. I think now is a incredible time, even in single family, backing up, go back to single family right now. We're seeing we've bought probably 20 houses for zero down in the last couple of months. And before that, it was 20, 30, $40,000 out of pocket for every deal. So
Mhm.
it is definitely a buyer's market right now in the single family, in the commercial. This is the time to strike. If you're sitting on the sidelines, it's time to strike. And at this, I'll get your opinion on this. I think Warren Buffett pulled $166 billion out of the stock market within the last couple of years. And that's an indication that he thinks the stock market is overvalued, and there's a correction coming. But there's a lot of high profile people that are pulling their money out of the stock market and pushing it over into real estate. What's your opinion on that?
Well, that's definitely happened. Now, Warren Buffett also took a lot of that money out and invested heavily in two big home builders. I know D.R. Horton was one of them. And so he knows what's coming. He's a smart guy. And so he's looking at home builders being able to do well, take the money out of the stock market. Whether he thinks there's a correction or not, I really don't know. But there's definitely opportunities to take money out of the stock market and put it into other investments, such as real estate, such as the syndications we do. And as soon as that wave, as soon as too many of those people start doing that, that wave is going to crest and more people are going to pull money out of the stock market. Stock market will start to go down a little bit and more people will pull out. And so you want to get out ahead of the curve. So pull that money out, put it into hard assets like real estate, where you're shorting the dollar. You are putting an investment into hard assets that will keep up with inflation, that are not going to be affected like the stock market is. So I think it's a smart move to go ahead and pull out of the stock market and get into real estate.
Yeah, a lot of our clients, that's what they're doing. They're taking their IRAs, their 401ks, self-directing them, getting them out of the stock market and into real estate. And that's been a very effective strategy for many years. So, what's your next project, Darwin? Are you working on anything right now?
Oh, I've got a little deal, and part of our ethos is full transparency. So I'm going to embarrass myself here, right here on your show. Um, in 35 years, we've only had one losing deal, and that was one that I bought in 2009. And basically, I would say, and it's a cautionary tale. And I say I've got $1 million education in mistakes. Well, that was one of them. And so I lost money on that one deal. Well, right now we've got two properties that we got caught with our pants down, like a lot of other people. We had a bridge loan that we took out in 2022, beginning of April 2022, right before the rate started rising.
Sure.
Worst time to buy, 3-year bridge loan. And it was two separate properties, Amber Creek and Trails Place, that we bought in a portfolio. And those loans came due this last April. And well, let me back up. When rates started going up, I called the bank and negotiated with them to lock that rate. And if we wouldn't have locked that rate, then we would have been in trouble many years ago, because our interest rate would have doubled and our payment would have doubled, and we would have been upside down and been in a horrible position to have to sell. Well, now those loans are due, but we had to have a cash call to go ahead and pay down the existing loans because the values are down, cash flow is down. So to get it put into agency, long-term agency debt, we have to pay the loans down. So we did a cash call on one of the properties, but we wouldn't have been able to do a cash call for the second property. So the second property is called Amber Creek, and we're actually rebuying that from ourselves, just like I was telling you we did with Saginaw Crossing.
Right.
A lot of meat on the bone on that. So we're raising money for that particular deal, and unfortunately, we're capturing a loss on Amber Creek, and we're hoping to make that up on Trails Place that people still have money invested in. And so it's not an absolute loss overall. We still have the opportunity to get everybody's money back and make some. But the cash call, people that put money in that cash call, they'll make about 20% per year on their investment
Wow.
on that on Trails Place. But on Amber Creek, which we're rebuying, um, we're projecting it's about a 20% return on that, average annual return on that property. And we're buying it at a 25% discount over what we paid for it before. And we know where all the bodies are buried. We know what the upside is. It's a great asset, which is why we're rebuying it from ourselves. Somebody might say, well, how does that work? We actually put it on the market. First off, we had an appraisal, so we knew the value. We put it on the market, and so that we can see if there's any other anybody that wants to buy it. And so then we beat that highest offer that we had after a best and final with potential other buyers, and we beat that price to get more money for our current partners. Plus, we're not paying a commission on it, so we'll make money on that property to go ahead and put back into Trails Place. But Amber Creek is a great deal. We're looking at immediate cash flow, buying a 25% discount, 20% per year average annual return, and about 60% bonus depreciation in year one. So
Wow.
it's a great opportunity. 3, 4, 5 years ago, that money would have been raised in a day.
Yeah.
But now people are just scared, and there hasn't been the churning of money with buying and selling and getting money and reinvesting it. That hasn't been there, and people have been tapped by cash calls on some properties or losing others in their other investments, not with ours. Um, and and so it's hard to go ahead and get people to invest. They're just scared and not ready.
Yeah. And it's shocking because this is the time. It's like people are always trying to time the market. They're trying to crystal ball it. Well, there's no reason to crystal ball it. This is the time. Like you said, it's at 5:30 or 6 right now. This is the opportunity, and people need to be striking when the fire iron's hot, I guess, as they say.
Yep.
So, in closing, just closing thoughts, what would be your advice to someone who's thinking about becoming a passive investor, um, and they just haven't made that decision? They're sitting on the sidelines going, they've got their money in the stock market. What would you be your advice to them?
Well, can I give you a plug?
Yeah.
Okay, because Total Wealth Academy, they do great on education and mentoring, and you really need to know what you're investing in. A big thing is get some education, understand what you're going to put your money into, and understand how it works. It's not like a mutual fund where you just throw money at it and hope that the money managers are doing a good job. You're investing with a syndicator, and in a lot of cases, most of the time, in a property you already are aware of. So you can do your due diligence, but if you don't know what you're looking at on vetting the sponsor or vetting the property, then you're just throwing darts at a dartboard. So by going to somebody like you and getting that education, you understand those people can then understand what they're investing in, what they can expect. And for a syndicator, for me, I love that because I get less questions, I get less problems because they know what's going on. And a big piece of the transparency, like I was talking about earlier, um, you've got to trust your partners. They're all in business. They put money invested with you, and so you've got to take that very seriously. You've got a fiduciary responsibility to protect their investment the best you can, and we take that very seriously. And if you know what it is, you've got to trust that that you can communicate the problems you're having with your partners. Because if you just stick your head in the sand, like so many people have, they just get run over. But by being transparent and having that communication, you're not going to call up the president of AT&T and T and find out what's going on. And at least you can do that with syndications.
Yeah,
So
that's
so
one thing.
syndicated, go ahead.
When you've got your own real estate, if something goes wrong, you just go solve it. Or if you're
Mhm.
in a syndication, you can actually talk to the syndicator and find out what his
Yep.
plans are or her plans are to solve the problem. All right. Well, I really appreciate it. Those of you listening for first time, this is the Total Wealth Academy video podcast. our second episode with Darwin German. Darwin German is a sponsor and syndicator here at Total Wealth Academy. He's somebody you could invest with if you were a member of Total Wealth Academy. And what he was mentioning as far as the education, we actually have a 16-hour course that teaches you how to be an effective passive investor. It teaches you how to underwrite apartment complexes, self-storage complexes, senior living complexes, and more. So you can check that out. But thank you, Darwin. I sure appreciate it.
Thank you so much, Steve. I appreciate being on it. The second show. Hey, I'm honored.
Hey, I know. I feel pretty good. Thank you.
All right. Thank you so much.
Take care.
Bye bye.
Bye bye.